Today we're looking at a bull case for advanced micro devices.
That's right. This analysis report details how catalysts like CES 2026 and strong Q3 financials could pave the way for the stock to hit $280.
It's a strong structure, very clear specific data points like the January 5th keynote date.
It is. So let's jump right in and see how we can elevate this from a compelling argument to something, well, exceptionally robust.
Sounds good?
So a key theme here is obviously that extreme conviction, right? The aim for new all-time highs.
Absolutely.
But our first piece of feedback really focuses on the completeness of that conviction. The analytical framework needs to be strengthened by integrating a comprehensive assessment of counterarguments to support the material's strong conviction.
Right. That conviction, it's infectious, it really is. But here's the weakness.
Okay?
The report's overwhelmingly bullish tone is engaging, but it also risks undermining its own credibility.
How so?
By failing to really anticipate or mitigate any of the potential failures. I mean, this is a high conviction call.
It dismisses the bear case pretty quickly, doesn't it? Just says it's disappearing.
Exactly. And that just feels too thin for a target as ambitious as $280.
I get the instinct, though. You don't want to give the bears too much airtime when you're this confident, especially with those data center numbers.
Of course. But modeling the downside risk is absolutely essential for a bull report.
Why's that?
Because the whole analysis relies so heavily, maybe too heavily, on the CES 2026 keynote being a home run.
The product offensive.
Yeah, the whole Instinct MI400 series, the supposed NVIDIA killer, Zen 6, all of it.
And the risk is what?
The risk is that the report gives the reader no plan B. There's no contingency if those reveals get delayed or if they're just lackluster.
Or, and this is critical, if they're already priced in by the time the event happens.
That's the big one. A truly robust bull case has to anticipate the road bumps.
So by ignoring the roadblocks, you're not actually proving conviction. You're just showing an optimism gap?
Precisely. So the suggestion here is pretty straightforward.
Let's hear it.
Introduce a dedicated section. You could call it contingency and validation thresholds or something similar.
I like that.
And in it, you detail the potential pitfalls, the variables that could delay the breakout or even invalidate that $280 target.
And that shift is important. It moves the report from feeling purely promotional to being
powerfully analytical. It shows the author has actually calculated the risks, they understand the failure points, and decided the reward is still worth it.
right. Integrating that risk assessment would actually bolster the conviction. It proves the diligence behind it.
Exactly. So give me one or two really specific pitfalls that, if modeled correctly, would actually strengthen the case.
Okay, so we need examples tied right to the catalysts. First, detail the operational risks. The material mentions analyst upgrades, right?
It does.
So use that. You could detail risks like potential delays in the MI40 ramp-up cycle, which, some firms like Loop Capital might have cited in the past.
So you're showing you're not ignoring other opinions. You're quantifying them. That's it. It makes the analysis layered.
And what about the competition?
Oh, absolutely. You have to model the market reaction if NVIDIA or Intel comes out and matches or even beats the expected performance of the new Ryzen AI mobile chips.
Because if the new chips are just a little bit better, the stock isn't going to jump to $280.
Not a chance. You need to explicitly state the performance delta required for the whole thesis to hold true.
And then finally, you can anchor that risk to the technicals. That gives a clean exit strategy.
Yes, tie it all to technical support. The technical section already mentions that $198 to $200 double bottom level.
So you define that level.
You explicitly define it as the ultimate failure point for the bull thesis. It gives the reader a clear safety threshold that if this, then that scenario that sophisticated investors demand.
A comprehensive analysis has to establish the floor before it can claim the ceiling.
Perfectly put.
That is highly actionable. Okay, moving on. Let's dig into the financial foundation section.
The Q3 numbers.
The Q3 numbers. The report makes a strong case for growth here, right? It highlights the $4.3 billion in data center revenue.
Up 22% year over year, which is huge.
And a net income soaring 31%. This historical performance, it provides a crucial safety net for the stock.
It's a great starting point. A very solid base. But we need to enhance the significance of those figures to really justify that future valuation.
Okay, so our topic sentence here is, to fully establish the path to $280, the analysis must translate the historical financial foundation into a forward-looking valuation model that mathematically supports the consensus price target.
That's it.
So the weakness, as I understand it, is that the connection between those amazing Q3 results from 2025 And the ambitious Q1 2026 targets?
The $280 to $300 range.
Right. That connection is currently made mostly through the analyst upgrade cycle. It mentions Jefferies and Piper Sandler, which is good context, but
it's relying on their authority. It's not using its own math.
exactly. It's relying on external validation instead of internal financial modeling.
And the reader, who is deeply invested in this $280 path, doesn't just want to know who said 280. They want to know how the author of this analysis justified it themselves.
And without that bridge, if Jefferies downgrades,
The whole conviction of the report just crumbles, because the core math wasn't there to begin with.
that's a massive vulnerability for a high conviction piece. The analysis has to own its target.
It has to.
So the suggestion is to integrate a projected financial component. But how do you do that without just, guessing future revenue?
You don't guess the revenue. You calculate the required revenue.
Ah, I see.
You show the required acceleration in data center or AI revenue that must happen in Q4 2025 and Q1 2026 for that high-end valuation to make any sense.
And that provides the mathematical why behind the analyst targets.
And the report's own conviction.
Give us some concrete ways to model that jump from historical strength to future value.
Sure, you've got a few creative options here. First, you could model the implied market cap, or maybe the required price-to-sales ratio if the stock actually hits $280.
Okay.
What PS multiple is the market assigning it at that level? Just showing that number helps contextualize the target. It's a valuation anchor.
And building on the Q3 data, we could link that required growth directly to the MI400 ramp-up.
That's the most potent way to do it. Calculate the projected year-over-year data center growth rate needed to sustain that price. It's currently at 22%. What does it need to be?
And then link that required rate directly to the MI400.
Exactly. That makes the whole CES event quantifiable from a P&L perspective. It's not just hype anymore.
And what if the target relies more on the AI PC supercycle? That's a big narrative right now.
Right. If that's the angle, you could focus on margin expansion, project the necessary gross margin improvement, or the volume increase you'd need from the new Ryzen AI mobile chips to hit that milestone.
That kind of foresight just maximizes the credibility. It shows how all the different parts have to work together to get to that new all-time highs thesis.
It really does.
That's great. It transforms external validation into real internal strength. Okay, for our third critique, let's turn to the flow, specifically the technical section.
Section 4.
Section 4, it uses crucial jargon, double bottom, the breakout line at $225, Fibonacci extension, all important targets. But the section on technical analysis should be integrated more seamlessly into the core investment narrative to ensure the material remains persuasive across all levels of expertise.
I completely agree. The concepts are strong, but the way it's presented risks isolating a big chunk of the audience.
How so?
Well, the technical analysis section right now, it just reads like a disconnected checklist of indicators. It's not part of the story.
And the weakness is that the jargon.
Fibonacci extension, without translating them into clear market behavior, it just slows the whole thing down. It assumes this deep technical literacy from every single reader.
And that's a bad assumption. It becomes a hurdle, and it could push away the people who are more focused on the fundamentals, the MI400, the Q3 numbers.
The very people you've been convincing up to that point. It's an issue of tone and style. The language has to serve the narrative, not become a barrier.
So what's the suggestion?
Synthesize the technical data into practical time-bound checkpoints for the investment thesis.
So rephrase it.
Rephrase the technical language into clear, descriptive implications for timing and conviction. The technical should be answering two questions. When should I act, and when is this whole idea wrong?
That shifts the focus from charting geometry to actionable market timing.
Exactly.
So instead of just listing targets, you frame them as psychological or structural hurdles the market needs to clear.
That's the perfect way to put it. Let's take target 1, $267, previous all-time high.
Okay.
Instead of that list format, describe it. You could say something like, once the $225 to $230 resistance is convincingly broken, confirming momentum, the market's next psychological hurdle will be challenging that previous all-time high, $267.
And you can add more color.
You can add more color. You could say, this is the point where older investors who bought at the peak will face the decision to sell or hold.
That's a huge improvement in accessibility. It ties the chart behavior back to actual human psychology.
It makes the technical section part of the path to $280 narrative.
And you can apply that everywhere.
Everywhere. Reframe the actionable insight, that daily close above $220. Frame it as the immediate confirmation signal you need before the CES hype cycle can really start moving the price towards $267 or $280.
You're telling the reader exactly when to pull the trigger.
You are. And we already talked about the importance of that $198 to $200 level in our first critique on risk.
We should definitely link that back.
Most powerfully, yes. Show how the successful defense of the double bottom at $198 ties directly into the safety net concept from the financial section.
Reinforcing that fundamental strength underpins the technical structure.
And now your technical section is an indispensable, narrative-driven map for the whole investment story, not just a technical annex at the end.
This has been a really deep dive. So to summarize, we have 3 key high-leverage opportunities to strengthen this analysis report significantly.
First, bolstering the material by explicitly modeling and detailing the risks, especially the risks around that big CES event. It turns conviction into a calculated, hedged position.
Right. Second, enhancing the financial rationale. You have to mathematically bridge that Q3 performance to the ambitious $280 target. Build the internal financial architecture to support the call.
Don't just rely on the analysts. And third, integrating the technical analysis more fluidly into the narrative. You want to translate that jargon into clear, universally understood investment signposts.
And timing mechanisms.
Implementing these changes will transform the material from a strong, optimistic bull case into an exceptionally robust and balanced analytical report. It'll just increase its persuasiveness and credibility across the board.